Hello, I'm Jacob Stein. I'm a partner at Aliant's Los Angeles office, and this is a presentation of how the United States taxes foreign investors who come to the United States. This is a brief overview of U.S. taxation of foreign investors. So this is just a summary of U.S. tax rules, and in other videos we're going to go into more detail into each of the issues that foreign investors have to deal with from a U.S. tax standpoint. So how does the United States tax foreign investors? There's a separate set of rules that exists in the U.S. law, specifically dealing with taxation of a foreigner who comes to the United States and either buys assets in the United States, invests in U.S. real estate, invests in U.S. business, engages in business operations, actively engages in business operations in the United States, or may simply have some property in the United States. So what are the U.S. tax rules for foreigners in the U.S.? Well, there are several sets of rules. We have income tax rules that govern how we tax foreigners who receive income from within the United States. And we also have estate and gift tax rules that deal with foreigners who make gifts of assets within the United States and with foreigners who die owning assets in the United States. So first, briefly, let's deal with the income tax rule. How does the United States tax foreign investors? So if a foreigner operates a business in the United States, like an active business, let's say a foreigner bought a restaurant here in Los Angeles and they're running that restaurant. Whatever earnings that restaurant has, the United States will tax, and the tax rules that apply to this foreign investor in the U.S. business will be exactly the same that would apply to any other American taxpayer. The restaurant has earnings, it has expenses that will offset those earnings, and the foreigner will be taxed on the net income that they generate from this restaurant. Right? So with an active business in the United States, taxation is fairly straightforward. The foreigner will have to file a full tax return, a full tax declaration with the United States tax authorities, reporting the income, reporting the expenses, and paying taxes on the net profit. What other types of income can a foreigner have? Well, the other big category of income that foreign investors have in the U.S. is passive income. Interest, dividends, rents, and royalties, right? Those are the four major categories of passive income. For U.S. tax purposes, this category of income is known as FDAP income, fixed determinable annual periodic income. Just a technical term that's used in the tax rules, and you may hear your tax lawyer, your tax accountant throw that term out. It really just means passive income. How does the United States tax foreigners on passive income? Well, that tax rule is actually very simple. A foreigner who earns passive income in the United States usually is subject to a 30% withholding tax. What does that mean? Let's say that you live in Switzerland and you come to the United States and you buy some shares in Microsoft. And at the end of the year, Microsoft pays you $100 dividend. How are you taxed on that dividend? Well, under the U.S. tax rules, there's a 30% withholding tax. And the obligation to collect the tax is imposed on the person paying the dividend, meaning on Microsoft in my example. So Microsoft will take this $100 dividend, send you, the investor, $70, and will send $30 to the United States Treasury. So Microsoft is withholding the $30 tax, the 30% tax, and sending it to the United States Treasury. You get your remaining $70, and you have no other tax filing or tax payment obligations with the United States government. So 30% withholding tax. It's a very high rate of tax. Fortunately, if you live in a country with which the United States has an income tax treaty, and there are 50-some countries with which the United States has an income tax treaty, that 30% withholding tax is reduced. And it is usually reduced to anywhere from 0 to 15%. Right? So with our stronger trading partners like UK, Germany, maybe Switzerland and France, the withholding rate will be anywhere from 0 to maybe 5-10% at most. With many other countries, the withholding will be 10 to 15%. So we pay, let's say, if you live in Switzerland, you likely pay 10% withholding tax, so you get $90, the United States Treasury gets $10. That's passive income, FDAP income. What other categories of income do you have in the United States? Well, you may have money sitting in a bank account, and the money sitting in a bank account may be earning interest. Is interest subject to this 30% withholding tax? Interest generally is subject to the 30% withholding tax, unless it's interest from a bank account. Interest from a bank account is exempt from US taxation if you're a foreigner, okay, which is a really good news. We want to encourage foreigners to put money into our banks. If you buy assets in the United States and then you sell those assets, and if those assets are not real estate, the United States will not tax you on your gain. Okay? So if you buy, let's say, intellectual property in the United States, like a patent, and then later resell it at a large profit, no taxation by the United States. Taxation of real estate, the sale of real estate, is subject to its own tax rules. It is subject to the standard U.S. capital gain tax rates, which is about 20% in most cases. There are withholding rules that apply, and taxation on the sale of real estate we will discuss in more detail in another video segment. And finally, the United States will tax foreigners with the estate tax and the gift tax. So if you are a foreigner, you have assets in the United States, and you take these assets and you gift it to someone else, whether that person is here in the United States or outside the United States, you are subject to the U.S. gift tax on the value of the asset gifted. And that's a 40% rate of tax. So we need to very carefully plan to avoid the application of that tax. The estate tax applies to any assets that a foreign investor owns in the United States at the time of death. Again, it's a 40% rate of tax. So whether a foreign investor owns real estate in the U.S. or an interest in a legal entity or anything else, 40% goes to the U.S. government when that foreign investor dies. This is the primary reason as to why we structure foreign investment in the United States to always run through either a foreign corporation or a foreign trust. So this way, when our foreign client dies, they do not own assets in the United States. What they own is a foreign entity or a foreign trust. And they do not directly own assets in the U.S. But again, we'll do another video that in more depth explains the taxation of foreigners for gift and estate tax purposes. I'm Jacob Stein. Thank you for listening to this video.